Welcome to Investment 360. First on the hot seat this evening, Linda Eedes from Regarding Capital Management, and of course my co-host Kevin Lings from Stanlib, still in studio. Linda, thanks very much for your time. Looking at the Global Flexible Fund at ReCM, you invest both locally and globally. Right now, though, you're quite heavily skewed to the offshore side of things. That's just because you see more value in that environment.
Absolutely. In fact, we have close to, in fact, it's 50% of the portfolio is now invested offshore. And that portfolio is benchmarked against, we have quite an ambitious absolute return benchmark at CPI plus 8, which I don't think you'll see many funds out there with that benchmark. But we've managed to achieve that over the 8 years that we've managed the fund. In fact, we've delivered 10% real return per annum. So, you know, going forward, it's going to be a bit more difficult in the near future. I'm sure Kevin would agree. But we think over the long term that that's still achievable.
Linda, just help us to understand, or help me to understand something. I mean, this is a global fund. You invest in different asset classes, locally, internationally. You are picking stocks. In other words, there's a lot of work going on. What is the overall approach? How do you go about it? Without, I mean, if you can give us some sense of what is the technique, what is the way in which you're trying to find that value, given that it's a big world out there?
Yeah, absolutely. Well, we are unashamedly value-based investors, so everything is done from the bottom up, in the sense that we don't have a top-down macroeconomic forecast which dictates how much equity, how much bonds, etc., etc. So we look at each investment case on a case-by-case basis, and what we're looking for is absolute value. So we're looking for securities, equities, which are trading at 30% or more less than what we believe they're worth. And all of our work is done on valuing those equities and those other securities and other asset classes. And when we see the opportunities, we invest.
So the key is to picking up good companies cheaply.
Absolutely. And you've touched on another part of our philosophy, which is to focus, especially globally, on high quality companies. What do I mean by that? I mean businesses which often have barriers to entry in the industry that they operate in. They've got, as a result, sustainable competitive advantages, pricing power, all those things which will make them more able to weather tough economic environments like we're seeing today.
Linda, before you tell us which is this magical company, or give us an example of that, yes. How do you actually go about finding those companies? Is it a computerized system where you're screening hundreds of companies and out are popping a number of companies that have got certain parameters and you're saying these are on our watch list, let's investigate a little bit more? Or is it visiting a number of companies?
Because your universe is so broad.
It is.
Considering
Absolutely.
the global environment that you are
correct,
working
both
in.
locally and globally. So we're looking at both for this particular fund. It's a bit of both. We do use screening. So in terms of focusing our hunting ground, often we do use sort of quantitative screening to see what is looking attractive, looking at the numbers alone. There we might look at historic price to book ratios, we might look at PE relatives to the market, we might look at, you know, companies which are trading at absolute lows. That's where we would then sort of do more analysis to actually discover, is this actually a value opportunity? We also read very widely. We tend to have a contrarian flavor to our investments. Why? Because that's generally where you find value, where other people aren't looking. So what that means is that, you know, we're often investing where others are not.
To that point, would you look very different to the market then?
We do, absolutely. And, you know, to give you some examples, most of our global investments are in, for instance, the US. We have some in Europe. We even have one or two in Greece. Can you believe that? I'm sure that, you know, sounds quite surprising. But these are high quality companies which we ultimately think that the market is discounting even more bad news than you're likely to see.
So they've been beaten down by
Correct.
sentiment rather than fundamentals reflecting their true price.
Absolutely. And in many cases, looking at some of the US multinationals that we invest in, looking at this particular company in Greece, they've got very diversified revenue streams. So they're not just accessing that particular geography and, you know, the economics of that, you know, US consumer. They are globally diversified in terms of their revenues. And, you know, to list a few examples, you know, Microsoft, Johnson & Johnson, Dell, these are all companies, Walmart, which have diversified globally.
How long would it take you to identify a company and then ultimately investigate it and get really comfortable that this company ought to be in your portfolio? What length of time would that typically be?
It can be quite a long period of time, longer perhaps than for other asset management companies, because our conviction needs to be on that value that we put on the business. We are not spending time trying to forecast short-term market movements. We don't have any competitive advantage there, but then we believe that nobody else in the business does either. What we're trying to do is use market prices as an entry or exit opportunity based on our value. So it can take a month, sometimes 2 months. And the crucial thing is that we do that work not in the heat of the moment when the market's collapsing. We do that work ahead of time so that we know what businesses are worth. When the market falls because of jitters, uncertainty, etc., we're able to actually act, which a lot of investors aren't.
So let me ask you an unfair question. Sorry, Bronwyn.
Am I going to allow you an unfair question?
I don't know.
I want Linda back in the studio.
Okay.
All right, go with the unfair
Okay, so an unfair
question.
question, but it relates to the show today.
Yes.
And that is the Research in Motion share price is down like a lot, like 60% in a couple of months. Okay, so it is a stock that has been beaten down.
Right.
It has got good technology. It has got good management. So on the face of it, it would tick some of these boxes.
Yeah.
Is that sort of thing you would look at? Is it in your portfolio?
No, it's not in our portfolio. We do have quite a few technology stocks globally, and I think I've mentioned a few.
You've mentioned Microsoft.
Dell, Intel, I've mentioned on the program, if not tonight. But we haven't invested in that particular company. As I say, we aren't also trying to value every single business out there. You know, you can't. We know that you need sort of 30 to 40 good investment ideas in a sort of overvalued market, even less in a very compelling value market, to generate good returns for your clients over time. And I think that's one of our strengths, is that we focus on where we're good and we don't try to be all things to all people. Are we going to find that little obscure company in Brazil that's going to, shoot the lights out on the growth story? No. We're sticking to what we do best, which is valuing high quality businesses, which we believe also protects against downside risk.
So then,
talking about your contrarian view, there are a number of market commentators who've given up on the Sun International story. And I look at your top 10 holdings, September 2010 and September 2011. Sun International still at the top of the pile, making up some 5.1%. You've got 5.1% of Sun International. I mean, it's in your equity portfolio at 5.1%. Yes. Let me get this right. Why such conviction on Sun International?
Well, a number of reasons, and that will also help to highlight our decision-making process in the investment decision-making, which is, first of all, we believe it's a high-quality company. It has substantial barriers to entry. 85% approximately of its revenues come from gaming rather than the hotel side of the business. That's a very regulated industry. You need licenses to operate for the most part. They've got a substantial portion of those licenses. So there are a lot of barriers to entry which prevent somebody from just coming overnight and starting a casino here. So we think that those dynamics protect it to a certain extent. It has earned good excess returns on capital over time if you look at its history, but it's at a cyclical low, and it is a cyclical business. Gaming revenue is highly cyclical, and the operating margins tend to move with the cycle. Now, the market tends to look at earnings today and extrapolate whatever's going on today into the future. And businesses that are at cyclical lows, the market tends to look at those earnings and say disappointing, something else more attractive. The market tends to overvalue businesses which have cyclically strong earnings, and they sort of priced for the best news forever after. We like businesses at cyclical lows because for us that's also often a value opportunity where investors aren't looking through the cycle. And in fact, we've actually recently increased our exposure to Sun International.
At 83 Rand, do you have appetite for Sun International?
Actually, no. But mentioning the gaming part of it makes a lot of sense because there are barriers to entry. I mean, in general, we don't like the hotel industry or the accommodation industry that has been fairly substantially beaten up, and I don't think it's necessarily going to make a recovery. But certainly the gaming element, perhaps we have to look at it, or certainly look at it now. I just want to ask one more question. So you've put all these stocks in your portfolio, you've taken a month or two to select them. They're at cyclically lows, they start to recover, you're making lots of money for your clients. How do you exit the stock? What is the signal to sell the stock?
We have a very strong discipline at the firm, which is that when it starts to reach somewhere around our fair value for the security, what we think it's actually worth, no matter how much momentum there is, no matter how much positive sentiment, we have to lighten or sell our position. And we know this works because we didn't invent value investing. Obviously, it's worked for far more famous investors than ourselves. But it works because that momentum can only go so far, and you have no idea how long it will last. So you are better off actually stepping aside and letting other investors get that last 2 or 3%, because when the price collapses from very overvalued levels, you're actually going to more than make up what you left on the table at the top of the market when you protect capital on the downside.
And let's face it, it's too difficult to time the market.
In fact, it's impossible.
Exactly.
And in the industry, we tend to, when people get market timing right, they say it's because of our skills. When they get it wrong, they say, oh, well, unforeseen circumstances. And we just don't want to put our clients' investments at risk on something we have no conviction in.
Can we quickly touch on Amplats before we run out of time?
Yes, absolutely.
It's one of the stocks that you have highlighted that you would like to focus on. What is the investment case behind it?
Well, it's got to do with the dynamics of the platinum industry itself. Obviously, contrary to gold, platinum hasn't had the sort of surge in prices that you've seen in gold. Gold largely sentiment, that store of safety, store of value kind of argument, deflation hedge, etc. And often, it goes both ways, however the story spins. But platinum is largely an industrial commodity. As a result, it's unpopular today. The price hasn't reflected because it's largely correlated to, automotive industry, that side of things. And we think that the demand is still there for platinum. We think that the supply is not going to actually match demand. And Amplats, relative to other platinum companies, it has far leaner margins. It doesn't have the nice fat operating margins of something like an Implats. And as a result, we think from a value perspective, they have scope to cut costs, and that makes it compelling for us.